As an organizer and may now speak to any other organizers or panelists on the line. When you are ready to begin the presentation, press the Start Broadcast button on the GoToWebinar control panel to allow all attendees to hear you. This system will notify you once you begin your broadcast. The broadcast is now starting. All attendees are in listen-only mode.
For BMO, as well as highlight what we're seeing in the markets. It's been about a month since we did our last presentation. September's been a bit interesting, so we'll address what we've been seeing in the charts and what we can, I guess, infer from that going forward. In addition to myself, I'm going to be we're going to have Paul Vendrinsky talking a bit about our funds and the quarter that we just closed, and which has been quite a strong quarter for us and relative strength. So that'll be a good conversation. I'm going to do a quick positioning piece on one of our funds, the North American Focused Fund, and talk about momentum with a floor. And then I'm going to pass it over to Colin Sazinski, our Chief Market Strategist, to talk a bit about market outlook and what we've been seeing in the funds. If there are any questions, please write them out in the question tab, and we will answer them at the end. And if there's anything that follows up, please reach out to either your BMO sales rep or anyone from SIA, and we're more than happy to help. So without further ado, I'm going to pass it over to Paul Vendrinsky to give us a bit of a fund update.
Thanks a lot, Ted, and thanks everybody for joining us here today. We're just go over the quarter for the various funds here. Right off the bat, you know, we saw for this third quarter of 2020, we've seen a very strong performance in the equities markets, but both continued volatility, both in fixed income and the equities. But overall, that main strength in the equities came through in July and August. Bit of a pullback, but net overall strong gains. And as with all mandates, if you go to the next slide, Colin, we'll have a snapshot of what happened over the quarter. But with all mandates, we're really closing in on the gaps that were created earlier in the year. Maybe I'll start with, you know, looking at the global bond portfolio, for example. We continued to play that catch up with what took place in March, where we are making progress, but unlike, say, the speed of the equities that we're seeing, closing that gap is going to take a little bit of time. As you know, the corporate bonds, especially back in March during the pandemic sell-off, were the ones that were hurt the most. We did rotate out of most of those names, but as a whole, bonds or fixed income as a whole still remain fairly volatile. Even very recently, you would have seen that the longer-term U.S. Government bonds, this is the 20-plus year duration, took quite a hit. So luckily, within our fund, our duration being more around that 10-year mark, we did cushion a bit of that. But nevertheless, it has been it is a volatile asset class. And again, we're going to take some time here to close in on the gap, but we're positioned where we're still seeing strength, which is predominantly still U.S. bonds. But going into the next quarter, this gap should shrink. It just takes a little bit more time than the equities. Speaking of the equities, you can see here we had a really strong 3-month number across the board. Any portfolios that held equities saw a lot of strength. And, you know, it's funny, the contributors we're seeing across many sectors, not just the NASDAQ 100 names or a few names within that, which is really the headline news we see quite a bit. Of course, tech didn't disappoint. We did well with the tech, but we also benefited a lot from, depending on the portfolio, but benefited a lot from exposure to sectors such as the retail sector, also media, industrials, consumer discretionaries, and staples were strong, and even utilities and transport. So a wide cross-section of strength over the quarter and names that we hold within the portfolio. So we are very diversified, and we're seeing strength in a lot of different areas. And you'll see this on the commentaries that should be coming out pretty soon here, that we did rotate out of a number of things over the quarter in the various portfolios. And this rotations, of course, are all based on the relative strength rankings. So these are names that started underperforming versus their peers, but names such as Kinaxis or Shopify, BRP, First Quantum, Ovintiv, just throwing out some names as examples that are in some or all of these portfolios. These were all rotated out of, but most of them locked in a capital gain. So we saw gains that were locked in and profit on names that rotated out of, but then rotated obviously into relatively stronger names. So that was good to see. And we saw a fair bit of that over the quarter, in some funds more than others, but you'll be seeing that here soon. And before I pass it back to Ted, just in regards to the commentaries, please feel free to reach out to us. You know, constructive criticism is definitely wanted from us. We want to make sure you're seeing what you need to see and able to communicate with your clients. So whether it's a quick email or a phone call, let us know and give us a little feedback on what we're providing you. I'll pass it to Ted here, who will give you some speaking points on one of the funds too. Thank you very much, everyone.
Great. Thanks, Paul. In addition, yeah, as Paul mentioned, we've just gotten the commentary for the end of the quarter, end of the month. That should be ready and being sent out either this week or I'm imagining early this week. He's right. We want to make sure you guys get the relevant information and how that fits. I'm going to briefly, before I pass it over to Colin, highlight one of the funds that's had a pretty strong performance in the last 3-4 months. Our SIA, BMO SIA focused North American equity fund. It's available in a mutual fund format as well as an ETF format. We get a lot of questions about positioning. Where do our funds fit if we follow relative strength? And then we have our equity action call overlay that has the ability to get in and out of the market. Where does it exactly fit in an overall portfolio? Well, we get asked that relative strength is a form of momentum a lot. A lot of people call us momentum managers. Relative strength is a version of momentum, but it is not always that. However, to play into that, we do understand that we are following price movement as it's going up and trying to get out of the way as it's going down. So we will admit to the fact that we do follow some momentum types trends. And factor investing has really been something that has been strong over the last little while, anywhere from size, value, low risk, quality, have all had their different periods of strength. And multi-factor as well, a combination of them. There's lots of funds that have been launched with factor investing at the core. Every one of these that you look at, momentum tends to be one of the strongest factors from a performance basis, and we do agree with that. And as you can see from this slide, it shows all the different factors competing against each other, where momentum is quite strong. One of the criticisms of momentum investing is that, yes, it can rise up very quickly, but it can also fall down very quickly. And you see that in things like a tech bubble, the FANGs, other things like that. So you get these companies that can drive the momentum very quickly as everyone piles in, but it can also lead to pretty sharp and severe drawdowns. So that's why we wanted to introduce ZFN as if you go to the next slide, we're going to call it momentum with a floor. And this is really where that SIA strategy can add to it by getting out of the way. We're not trying to catch that drawdown. We are obviously going to get a bit of a drawdown. This is an example of 2020, and we're comparing our North American ETF with another Canadian momentum ETF, WXM. This just gives you an idea of what we mean when we talk about investing with a floor. Momentum, we have the ability to participate on the way up, yet having that equity action call overlay where we have the ability to get out of the way is really something that's key. So as you can see here, the fund, ZFN, went up significantly in the first part of January, February. We got caught up in drawdowns at the end of February, beginning of March. We exited, so you can see the floor there. We were completely out of the equity market. Yes, we missed some of the bounce back in April, but we're comfortable with that. And eventually we got back in and were able to participate. So if you look below, the comparison of these two funds is the year-to-date return is almost identical, but the max drawdown is really where momentum with a floor is an important factor. So it's about half the drawdown. So from a client psychology point of view, that's really, really important. I hope that every other type of bear market can have this steep and quick of a recovery. Realistically, that might not be the case. So the point is, we're comfortable having a momentum with a floor. And that's exactly, I guess, a way to position it. A lot of people ask us about factor investing. A lot of people ask us about momentum. And this is a great way to position a fund like the ZFN or the North American Focused Fund, is it does have that momentum, and we have that ability to provide that floor. So that's just a bit of a positioning piece. I wanted to highlight that specific fund. If there's any questions, feel free to ask. But without further ado, I'm going to pass it over to Colin to give everyone a bit of a market outlook. So.
Little technical hiccup there. September was a bit of a strange month for the markets in terms of that we had a great run off the bottom in July and August were extremely strong. We saw a number of equities perform really, really well, go to new all-time highs. But September we had a bump for a lot of markets, and we had a sizable, a decent-sized correction. The biggest, most obvious one being the Nasdaq, which between over 3 trading days between closing prices fell actually right almost dead on 10% to have actually an actual technical correction, and a number of other markets had more moderate pullbacks. But September was a bit of a choppy month. It's not unusual to see September be a little bit choppier. As we've moved into October, a number of markets have started to regain their footing once again. And looking here at the markets and at our asset class rankings, we'll see that, in fact, equities continue to hold down the 3 top spots in the rankings: international in first, U.S. in second, Canadian in third. Canadian equity had moved up from 5th place in late August, early September, and it's continued to hold that. Next 2 are the cash and currency, the 2 neutral asset classes, while bonds and commodities continue to trail. So overall, we're still in an environment where money flow is favoring equities. Capital is still been moving into equities relative to other asset classes, even though we have had a little bit of choppiness and a moderate correction in the markets. Looking at our market equal weight index, we can see what I mean, where we had a pretty strong move up through the summer. We actually did have a breakout to a new high, and then things slipped back a little bit, a small moderate correction here. But so far overall, the correction has been less than 10%, and it's looking like we're into a phase of consolidation within an ongoing upward trend. A number of markets had become a little bit frothy, a little bit overbought by the late August, early September, and we're just seeing some of that being unwound. And as we're in a period, we've been in a period of fairly low corporate news. We're in between earnings seasons. The earnings pick up again a little later this month. A few of the earnings that have come out have been fairly positive. Today's was Levi Strauss, but we've had a couple of weeks of late where we've had some pretty decent earnings numbers coming out, and so equities have just kind of been responding accordingly. We also, of course, have the U.S. election on, and other things happening that also have been influencing trading from day to day. Looking at our international equity equal weight index, international equities are still ranked #1 in the SIA asset class rankings. They're the strongest of the 3 equity asset classes. They do have the highest short-term SMAX score, and we have not even seen a 6% correction, which would tip it into from an upward X column to a downward O column. We haven't even seen that in international equities. Now, we are sitting pretty much close to previous highs, so we should get an idea from where do we go from here. Do we break out and keep on going higher, or do we have a correction and go into a sideways range? At this point, the jury's still out on that one. Looking at U.S. equities, which is our #2 in the SIA asset class rankings, we did see a bit of a moderate correction. We had a big run up through the summer, really, that started back in March. We saw markets falter a little bit short of their previous peak, but the correction was fairly short-lived. And what's important, we've got this green line that I've drawn in here, just showing consistently since March, each pullback has bottomed out at a higher low. We've moved into an upward column of X's right now, so the markets are slowly but surely working their way back up. Even in the last 24 hours, we had the hiccup and the bump yesterday afternoon, and then today we're seeing investors stepping right back in and continuing to support equities. So that's been quite constructive technically. We do see some relative weakness, have seen some relative weakness relative to some other asset classes in the short term, but so far it's still looking like we're in more of a sideways consolidation phase than anything else, and one that was a bit overdue. We'll see what happens once we move into earnings season, how investors are prepared to respond to that. Are they prepared to respond to good news, I mean, likely we would see weaker bad news get punished on the basis that just markets have gone up so much between July and now that expectations as a function of that and valuations are higher than they were. So people may demand more from third quarter results, although really it's still pretty foggy out there and could still be quite uneven between sectors. Some sectors have been doing really well and some sectors have continued to struggle. So it's important for us to remember that as well as we move into earnings season. Looking now at Canadian equities, we can see that we're overall long-term, we're still kind of just sitting in the middle of a sideways trend where we had a couple of drops, one in 2015 and one earlier this year. And otherwise, we've been pretty much in a wide sideways range for a long time. Now, Canadian equities did move up from 5th place to 3rd place in the asset class rankings. So we have seen over the summer some new interest in Canadian stocks. We're in a pullback right now where equities have pulled back between 6 and 10%. So it's a moderate, common correction, nothing to get right home about at this point. And really what we're looking at is we are in a sideways range with multiple resistance levels and multiple support levels for Canadian equities. And I'm going to speak to a little bit more about this on the next slide when I talk about sectors and industry groups. So this is the main rankings of the 11 main industry groups at the moment. There wasn't any major change within them in the last month, but differences in the industry group ratings can help to explain some of the differences in performance between countries, between indices, and so on. For example, in the United States, their major indices tend to be weighted. The NASDAQ is more heavily weighted in information technology, communications, and healthcare. The broader U.S. indices, again, tech, healthcare, consumer discretionary, industrial, a fairly wide and broad range. In Canada, we do have three sizable areas being materials, which is mostly mining and forest products. We have financials, we have energy, and then we have the everything else group. And what's interesting is that we had seen some renewed interest in Canadian equities over the summer at a time where when we look at these sectors, the bottom two are energy and financials. So we've got energy and financials kind of dragging on the TSX and holding it back. But at the same, so that suggests that, well, where we've seen the strength, well, it's been in the materials sector and also in that everything else sector, that's industrials, consumers, and utilities and other groups. And those areas have been performing quite well within the Canadian market. So that's something for us to consider as investors. And of course, also, if we do ever see financials and energy get going again, could be promising for the Canadian index. I wanted to look now at gold. Gold has been a hot topic of discussion over the last few months. It really started to rally, actually, initially broke out in the summer of 2019, then consolidated in a higher range, and then had another big rally, couple of big rallies earlier this year. The rally in the summer was particularly strong in gold. We've seen it take a very strong move up. It broke out to a new all-time high, blasted through the 2000 level, and then it ran into resistance about 2080, 2100, and has started to slip back. So gold right now is in a correction of around 10%. It's coming down back off the high. It's been trading around 1900. Not uncommon or unusual. It is still above the previous all-time high, which was near about 1820, 1825. So gold is holding above that. It does seem to be moving into, let's call it an 1800 to 2100 sideways trading range where it's digesting its move up from the past. Gold continues to have a tailwind from the massive monetary and fiscal stimulus that's out there globally. But what we may see gold respond to is changes in that from here. So we saw gold had a big run up, but of late, as central banks have kind of said, we're continuing to support, but we're not doing anything new. And so that's all kind of been priced into the market. And I think that's why we're seeing gold now start to consolidate and trend sideways. So we may see this continue for a while until we see either central banks say, we're good, we're starting to trim back, or it's time to hit the panic button and add more stimulus, and we'll see what happens. And as we know, and we've seen in the United States this week, and to a certain extent in Canada as well. The focus of stimulus and the pressure to do more with stimulus has shifted to the fiscal side. The pressure of late really has been more on governments to do more rather than central banks to do more. So that's something else to think about. It's a little different than the situation we were in back in the spring. Looking at crude oil here, this has been probably one of the biggest roller coasters out there that had the huge plunge from 60 to 10 or even down into negative numbers depending on what contract you were looking at it when the crunch came. And basically on crude, we've bounced back into, I'm calling it about the 45 to 55 range at this point in time. Crude oil would really need to get up through 55 to, I'm sorry, 35 to 45, my apologies. 35 to 45 range. Crude oil, we can see these long red downtrend line there. That comes in about 45. You would really need to see crude clear 45 to call off the current uptrend. It's currently trading in and around 40, and it's got support in the 35, 36 area at this point in time. What we've been seeing with gold is, so crude oil, day to day, we've seen some differences, some things related to supply. There were strikes in Norway. We've had Libya bringing production back on stream. A few weeks ago, OPEC extended their OPEC Plus extended their deal, and they're cracking down on cheaters. So there's lots going on there. But really, the demand is still the issue of where is global demand trending in an uncertain world economy, and that's one of the big things that's still lingering and hanging out there. I wanted to put in as a substitute for copper this month. I thought I'd put in the price of lumber. Both copper and lumber are kind of economic barometers. They respond to changes in global activity. Lumber tends to be significantly more volatile than copper, but so it does seem to have some pretty strong swings from time to time. Lumber is particularly sensitive to housing, construction, and forest products, obviously. Over the course of this year, from its low in April, was near 300. It peaked just around 800 before correcting back towards 550. Now, so what's important here was that we've had this huge run up. It did have a correction in lumber, but it did retest its previous breakout point successfully. And that's a sign of that the underlying uptrend remains intact. It has started to come back up. It still needs to break through 640 to call off the current downswing, but so far it does appear to be regaining its footing at this time after a massive rally and a sizable correction. One other thing I wanted to finish up and talk about here is soybeans. And soybeans and really the grain sector in general has started to attract renewed interest. Soybeans broke out of a downtrend and out of a base to the upside. They've got a strong short-term SMAX trading indicator, and soybeans is one of the contracts that's been leading a resurgence in agricultural commodities. That's grains, that's livestock, and some of the soft commodities as well. Things like cotton have been starting to pick up. And these are significant to me in a couple of ways. First, I'm looking at them for like things like metals and lumber as an indication of recovering demand. But of course, with it being more related to food costs and things, if we start to see these things really spike, could also be a harbinger of an increase in inflation. And with the massive amount of money printing we've seen over the course of this year from central banks all over the world, it's something we want to keep an eye on. So at this point in time, we can see within something like soybeans, it's been massively beaten down over a number of years, and it's just started to peak its head up, kind of like the gopher or in the whack-a-mole game, where it's popping up, but it remains to be seen, is it going to get knocked back down or stay up and keep going. It's a little early to talk about that for sure. So those were the main comments I had on the markets. Now I'll turn the floor back over to Ted.
Thanks, Colin. Yeah, so if anyone has any questions regarding some of the market outlook that we posted or any of the commentary that Paul or myself mentioned, feel free to write it in. We have a couple of questions that came in. So from our asset class ranking, it shows that commodities are at the bottom. Is that based on, I mean, obviously oil's risen, you just showed soybeans rising up a bit, but is commodities as a general asset class still ranked at the bottom? Any comment about that, Colin?
Absolutely, sure. Commodities have been really struggling, and it's important for us to remember that something like crude oil, yes, it's not at $10, but it's at 40, not 60 or 70, and so it's still substantially down from where it was. Copper had come up; it's kind of leveled off. Lumber is a smaller contract that's been all over the place, but commodity and as I noted, the grains, yes, they've started to come up, but we can see they're coming off some pretty major long-term lows. So it's intriguing at this point in time. The breadth in the commodities market is looking interesting. So does it have the potential to move up? Possibly. At this point in time, it's been reflecting the weakness that has been there, and we're just starting to see these turns, but they haven't quite turned up enough relative to other asset classes. Particularly relative to equities to move up the rankings as of yet, but it's something we definitely are keeping an eye on here.
And another follow-up question actually regarding lumber. Was the price of lumber impacted by changes in demand or changes in supply, as many mills were closed and no one apparently can get any lumber from the Home Depots across Canada? So curious about that.
I believe that. I know a number of some advisors have talked to me about that as well, of trying to go to Home Depot and seeing sky high prices. So it's probably a case, I would suspect, where earlier in the year they probably curtailed supply when the economy crashed and everything was locked in, and in some areas I think things have rebounded a lot more quickly than anybody realized. I mean, it's a funny thing because we look at some sectors are still struggling, and some sectors have rebounded quicker than I think beyond just about anybody's wildest dreams in March or April. So it's been quite amazing, and possibly some producers probably got themselves caught offside on that, and that's why we're starting to see some shortages now. The most volatile day for lumber too was the day the contract rolled over. So there were some strange things going on with that as well in terms of the pricing. Just like we saw with crude oil back in April, just around the time the contract rolled over was the one day it went into negative pricing and everything got crunched. We did have a crunch like that in lumber as well last month.
Okay. And I guess one of the issues is, there's obviously an election next month. There's a lot of uncertainty now, what a Trump win would mean, what a Biden win would mean. COVID second wave coming. A lot of people are looking at this saying, okay, is there any way that we can kind of understand where that money is going? But I think what we've seen is the current trend is still intact. It's continuing on with things like technology, et cetera. Still U.S. and some international sectors and areas are favored. And I guess it's more of just a wait and see as we haven't seen any clear trend being changed at this point. Is that correct?
That's correct. If anything, the one trend we've seen was from a stronger upward trend to more of a sideways trend, and that's kind of where we're sitting. And we may see this continue through October as people assess the earnings reports that have come out, and relative to expectations and what happens with the election. And the most important thing I think people are going to be watching for is there a winner? Is there a decisive winner? Are we going to end up in a repeat of the 2000 situation where the winner wasn't known for weeks and it ended up going to the Supreme Court and it was a whole big mess, and so that's one thing that's an issue is basically not only who wins, but ensuring that but will there actually be one, or is this going to drag on and cause more uncertainty? And that might be one of the things that's kind of holding equities back a little bit while all of this goes on.
Yeah, that's the worst case scenario, right? The uncertainty.
Yes. Yeah, the worst case scenario is there's no winner, and but then if you have a winner, then they can look at their platform and policies and say, well, we think they're going to do X, but
Okay.
Yeah.
All right. One follow-up question as well, probably to Paul Vendrinsky. ZFN, or the North American Focused Fund, I think it's predominantly U.S. exposure. So the question is, how much U.S. exposure, and has any Canadian exposure hurt the performance? And I guess that would depend on the sectors where we've been exposed to. So can you give us a bit more clarity into the North American Focused Fund, Paul?
Sure. Yeah, looking at the ZFN for the North American Fund, it's about 2/3 US. There's 5 out of the 15 are Canadian traded holdings, and out of those 5, speaking of gold, 3 are from the materials. So we own Teck, Agnico Eagle, sorry, and Kinross. So 3 out of those 5 are from a strong gold sector, so definitely not hurting us. Everything we still own is ranked fairly high, and the other 2 Canadians are the restaurant brands and Interpipeline. So as of right now, obviously they're in the portfolio because they still rank high, but definitely not. We're seeing some strength in Canada, and some of the names, like I mentioned, that we rotated out of, that we locked in gains, such as Shopify and Ovintiv, if you consider Ovintiv Canadian, I guess. Definitely net gainers and contributors for the quarter in the portfolio.
Okay. Yeah, I think part of it is understanding kind of how we're managing the portfolio, how we're upgrading some of these positions, how we're trying to position it for kind of whatever all-weather type of portfolio. So no, I don't think the Canadian exposure has hurt the performance. It's probably helped over the last quarter. So, okay. All right, well, I think that's all the questions that we have. Thank you, everyone, for joining us. And we're going to have another call in about 3 weeks on October the 28th. And we're going to give you some more insights and market outlook right before the election. And then we'll probably do another call right after to determine what we've been seeing in the charts afterwards. So look to have lots of contact with you over the next month or so. If there's any questions, again, feel free to reach out to us or contact your BMO sales rep. And thank you, everyone, for joining us. Have a great day.